Hi, everybody. This is Ron Sitrin. I'm here with Kim Cox, and we wanted to welcome you to this first-time homebuyer orientation. I'd like to start with just a story of, one of the things that we find, it just happens every year, multiple times. Somebody calls us up, they were referred by a friend, and they walked into an open house and they find a house they love, and they're really interested in buying it. And then we start talking to them about the process. Are you pre-qualified? Do you understand how this works? Have you seen other homes? Are you sure this home meets all your criteria? And all of a sudden it's like, wow, what just happened here? And they get a little bit confused because they did fall in love with the house, yes, but maybe they were rushing into the process a little too fast. Buying a home is a really big deal, and obviously it's a lot of money. It's a big commitment once you make it. The purpose of this orientation or this seminar is really to help you make that decision as wisely as you can and as informed as you can. So let's get started. So right now, a couple things. Especially for buyers in the Washington, D.C. market, there's three challenges that every buyer faces. And it's low inventory, that the homes are selling super fast. Many of them, the median time to sell for many neighborhoods is around 6 or 7 days. And many of the homes in some neighborhoods, as much as 40 to 60% of the homes are getting multiple offers. That makes buying a house in this market incredibly challenging and competitive. And our goal with everything that we're going to be teaching you now is to help you learn some of the things you can do to prepare yourself to win in a challenging market. The good news, though, is that even though this is a tough market for buying, and even though the prices are as high as they've ever been, interest rates are as low as they've ever been. And you can see from this chart that, there was a time when rates were at 16%, 13%, 7%, 8%, 6%. They're hovering around 3% right now. And that's fantastic for anyone that's thinking about buying. And that's one of the reasons there's so many people in the market as we're giving this orientation. So what are you going to learn today? First, the 6 steps to home ownership. We're going to go through those in detail. How wealth is created through home ownership. The magic of 5.3% as an interest rate. That's something I promise you never heard before until we give you this, till you hear this when we get to it. How to write a winning offer. And Kim's going to spend a fair amount of time on, how does this whole lending process work? She's going to really demystify it for you. And then how interest rates impact affordability, because right now interest rates are super low, but what happens as those rates climb? And then something especially helpful for the first-time home buyer, what is the rule of 66%? And you're going to find that helpful in helping you figure out your timing on when you should start your search. So let's get started. The 6 steps to home ownership. And we're going to go and unpack these in more detail, but very briefly, you get started by setting up the criteria and getting pre-approved. You begin your search, you find a home that's a winner, you make an offer on it, it gets accepted. There's a whole bunch of contingencies that need to be resolved. And locking in your interest rate, that generally all happens in the first 2 or 3 or 4 or 5 days. Then there's this period of time, where the loan just gets processed, things settle down all the way until settlement day. Settlement day is a big day for you. You're going to sign lots of documents. We're going to go over that as well. And ultimately, you own the home. And we're going to talk about on step 6, when you own the home, how is wealth created through home ownership. So getting started. There's 2 parts to getting started. There's 2 main players right from the very beginning. One is the agent that you're choosing to work with, and the other is the lender. Now, from the agent's perspective, that's what I am. I'm with Long & Foster. I'm a real estate agent. What you want to do is have an orientation meeting with your buyer agent, and you're going to go over, what is your price ranges? What is your search criteria? What is it you're looking for a home? You also want to know, based on what you're looking for, how many opportunities per month do you actually have? Because sometimes people, once they list their price range, the locations, and all the things they want in the house, maybe only one house that fits the criteria shows up every 60 or 90 days. That's going to be tough. That's going to be a tough road to success. Or for other people, they may find, that they get 7 or 8 opportunities per week based on what they're searching for to look at homes and hopefully find a winner. Ultimately, you need to understand what buyer agency is, how it works, and what the benefits to you are as having a buyer agent. And when you meet with your lender, the number one thing you want to do is get pre-approved right from the beginning. That's going to help you out tremendously because it gives you 2 pieces of information that are critical to this process. One is, how much cash do I need on this day of settlement? We call that cash to close. And the other is, what is my monthly payment going to be? When you take those 2 things together and you combine them, that's how you can figure out what ultimately your sales price is. So we got those things down. So step 2 is the search. So one of the things your realtor, or that at least we do it for all of our clients, is we go live with you in the MLS and we set up an actual search using the realtor database. Now, of course, Zillow and Trulia and lots of other sites, you can do this on that, but the realtor database is the most accurate of all the databases. And by setting you up that way, and make sure that anything that meets your criteria is going to show up on your list. It also helps pare it down, so you get rid of those things that don't fit for you as well. Ideally, what you want to do is see as many homes as you can as fast as you can, because what this helps you do is get an intuitive sense of value. And here's what I mean by that. If you're looking for a home that has some unique features, let's say you need a fenced-in yard for a dog, and you and your partner or your spouse, whoever it is, you want a double vanity sink, and you must have a garage, and you want a foyer, and some of these things you just can't get them for your price point. But when you find a house that has all of these things that actually fit what you're looking for, that's hard to find. And that intuitive sense of value for this particular house may be increased, and it helps you feel that much more confident when it's time to make it. But the only way you get an intuitive sense of value is by seeing a number of properties first and getting a look and feel for what the market is out there and what it's going to give you. When you do find a winner, typically you're going to first see it online through your search. When you see it, you want to get there fast. As we mentioned earlier, this is a super competitive market, and homes sell really fast. And while you're at the house, say, gosh, I really like this house. You want to walk through it twice. The first time you're just seeing it, and you're effectively, what happens is you're falling in love with it. But you want to do a second walkthrough, and you do that with a much more critical eye, because even though you're falling in love with this house, you want to know all of its shortcomings. It's best to know them up front, because once you go down this road of putting a home under contract, it starts getting expensive fast. And you don't want to find out a week into the process that you rather have not bought it. You can undo it sometimes, but it's better just not to go in unless you're going in with your eyes wide open. Your agent will play a valuable role in helping you critique the particular house. The other thing your agent's going to do is get you the seller's disclosures, so you can see what the seller has to tell you about the property. In addition to that, they should be able to get you recent sales in the neighborhood, so you have a sense of, hey, what do homes just like this sell for? We want to make sure we're paying a fair market value. Now, I know in a competitive market where things bid up, nothing may seem fair, but at least you want to be in step with what the market's demanding at this moment in time. And ultimately, the last thing you're going to do is you're going to get an updated lender letter from your lender, because you're going to include that as part of your offer. Which brings us to step 3. You actually make the offer. Now, just to give you a historical perspective, in good times or in bad, there's sort of a price range in which homes will, off list price, which you can expect. Typically, in a slower market, you can see homes get discounted as much as 3%, selling for 97% of the list price. And in a hot market, that's what we're in right now, homes can sell, 104%, 105%. And we're even seeing some sell at 110% of the list price. So you just have to know, based on the market, that there's some fluctuation on pricing. The other major terms that you're going to put in an offer is your settlement date. Typically, that's going to be anywhere between 30 and 60 days. And many times, if it's a vacant home, the seller's going to want a quicker settlement date. And if the sellers are living in the house and they just need a little bit more time to vacate, they may ask for a 60-day settlement. Your earnest money deposit, that's going to be the first time you actually write a check. And typically, it's 3 to 5% of the sales price. And so when the home goes under contract, that means the seller actually accepted your offer. Typically within 1, 2, or 3 days, you need to deposit some money with a title company. And that's called your earnest money deposit. Now, it's part of your down payment on the state of settlement, but it's the money that the seller knows that you put at risk to make sure that they know that you're serious about the deal. Many times when you buy a home, one of the most important things you want to do is have a home inspection contingency. And what this allows you to do is inspect the home. And in the event that you find defects in the home, a home inspection contingency generally will give you 2 choices. One is you can just say, you know what, I no longer want to buy this home, I'm just going to walk away. Or 2, I still want to buy this home, but I wouldn't have offered what I had I known of the following defects. Therefore, I want the seller to give me some money back at settlement so I can fix these after settlement. Either way, a home inspection contingency is there for your protection to help you when you buy a home, because you don't know anything about it. You've only seen it, maybe 1 or 2 times, and you're buying this home based on the disclosures that the seller's giving you. The home inspection period, you're typically going to bring in a qualified home inspector that helps you go through this process. Now, part of an offer, believe it or not, is you have to actually tell the seller what type of financing you're planning to get and what your down payment's going to be. And that's going to be critical information that you're going to get from working with your lender. That's something Kim will work with you hand in hand to make sure that that's all resolved up front. And so you know this before, you want to know this days in advance. You don't want to be learning this on the fly. And it's also common in slower markets to have what's called an appraisal or a financing contingency. And it's basically saying, if you can't get a loan through no fault of your own, then your earnest money deposit will be refunded to you, that it's not at risk. We are finding in hot markets, people waive that. And that's something, if you're going to do it, you need to do it with extreme caution. You get to, as the buyer, you get to ultimately pick who's going to do the title work. And that's the title work, is they're going to make sure that the seller says they are who they are and they actually have ownership of the property, because you're going to be giving that seller a lot of money. You want to make sure you're giving it to the right person. Generally, it's not an issue, but that's the purpose of a title company in this whole process. As I mentioned earlier, you're also going to have a copy of a pre-approval letter from your lender, because that's going to help the seller feel more confident in accepting your offer, because they want to know, are you pre-qualified? One thing to know about contract and contract negotiations is that in order for a contract to be enforceable, it must be in writing, it must be signed, and it must be delivered to all parties. So many times we get buyers say, hey, why don't you ask the seller if they'll do this, or ask the seller if they'll do that? Well, you could ask them, and maybe you get some intentions of what the seller may or may not be willing to do, but it doesn't mean anything. A real estate contract must be in writing. So ultimately, you get your home under contract. Congratulations. The single very first thing you want to do is let your lender know and lock in your interest rates. Interest rates can go up or down at any point. They tend to go down very slowly and go up very fast. So once you find the house you like, it's getting that interest rate locked. It's going to help you sleep at night, because you got a super good rate, especially in today's market. The next thing you're going to do, and this is going to be 1 or 2 days later, is going to wire that earnest money deposit over to the title company. And this, again, like I said, this can be your first big chunk of money leaving your bank account. And as we said previously, that is part of your down payment money, but it's also your at-risk money. In the event on settlement day, you just choose not to show up for whatever reason. And again, this isn't something that actually ever happens, but if it were to happen, that's the money to say to the seller, I'm voiding the contract, I'm not going forward, and here's what you get to keep as a result of me not performing on my end of the deal. Typically, the home inspection is going to take place in this first 7-day period. You're going to apply for homeowners insurance in this first 7-day period. And the reason that's important is sometimes when you apply for homeowners insurance, the insurance company may say, hey, that house had a series of floods in it, and that may be information you weren't aware of. And this is one of the ways you can find out about it. Or they may say that house is in a flood zone. So therefore, the insurance can be more expensive than you realized. And you want to know all these things up front. So you want to do this very quickly in the process. Once you get through this 7-day period, the part of working with your realtor actually goes quite slow for a little bit. And then it's really just a lot of back and forth with your lender. They're going to do a lot of paperwork to help finalize the loan. Again, Kim's going to talk about that in a couple slides from now. But ultimately, what happens is the appraisal happens, and the appraisal contingency gets removed. You get a financial commitment letter, and the financing contingency gets removed. And then you head on to settlement. And when we talk about settlement day, we really start talking about settlement day 3 days before settlement. And the reason for that is the federal government wants you as a buyer to have seen the financial documents that you're signing 3 days prior to settlement. And they're going to call this signing the closing disclosure. And it's actually a great rule, because it used to be, prior to this law being passed, buyers showed up at settlement and they were seeing documents for the first time, and it was just creating tremendous amount of confusion, especially if there was a mistake. So you get your settlement documents 3 days in advance, and you get to review them, and your lender's going to go over them with you. I know that's one thing that Kim does extremely well. 2 days prior to settlement, you're going to wire the remaining cash you need to close to the title company. So you've already given a earnest money deposit, but typically you're going to still need to send more money to the title company for the total amount of cash to close. And Kim's, as we go through this, is going to explain how cash to close gets calculated, but you want to have that money waiting at the title company on the day of settlement. Now, hours before settlement, that's a good time to do a pre-settlement walkthrough. And the purpose of a pre-settlement walkthrough is you go back to the property and you're seeing it again, and you want to make sure that it's the same way you expected it to be when you bought it. What happens if the basement flooded? Or what happens if there's a ton of trash in there that shouldn't be there? Or there's a tenant in there that didn't move out, or a tree fell on the roof? Anything can happen. Once you sign those settlement documents, it's now your house and your problem. So before you sign them, you want to make sure the house is the way you expected it to be. At settlement, then what's going to happen is you're going to sign 2 key documents. One of them is the promissory note, and that's your promise to pay. And the other is a deed of trust. And what that effectively says, by the way, if you don't pay, the bank has the right to take the property back. In other words, pay, you stay, don't, you won't. It's a simple saying they say in real estate. I'm sure your title company will say that to you when you're there as well. But the rhyme makes a lot of sense. Upon completion of signing all your documents, that's when you get the keys, the seller gets the money, and you get to move in. So congratulations, you're a homeowner. That's, it's great news. A lot of people, especially a first-time home buyer, we know you've worked a long time to save the money to do that. And just so you know, about 33% of all first-time home buyers do get a gift from parents. So if you're wondering if that's a normal thing or not, it's a very normal thing. 8% of repeat buyers get a gift from their parents as well. So if you're finding yourself a little bit short on money, just be aware that that's very typical for people in your shoes. So here's what I've seen over the last 20 years is that real estate tends to be a great source of wealth creation. And it's actually a really good source of generational wealth as well. And it's for two reasons. One is appreciation and the other is amortization. And if we look at this, this is the median sales price of US homes since 1960. And you can see that this line, although it goes up slowly, it just continually goes up. Now, the gray bars that you see running up and down throughout the chart, those are recessions. And so, yes, during recessions, home values do drop, especially the Great Recession. You can see a big drop there around 2008. However, give it a few more years, and then the home values seem to have surpassed where they were. So the first element of how wealth is created is that over time, and I'm going to say a long period of time, the property value tends to go up. The second thing that happens over a long period of time is the amount that you owe on your loan goes down. And that's the way that happens is called an amortization schedule. And so here's a sample of what an amortization schedule looks like. If you take a $500,000 loan at 5.3% interest rate, that would have you paying $2,776 per month. And by paying that monthly amount over 30 years, on your very last payment, you have paid down the loan amount that you owe to zero. So how is that calculated? The very first payment that's made, you take 500,000, you multiply it times 5.3%. That gives you an interest rate. You divide it by 12. That gives you the amount of interest that you need to pay. And that amount of interest is going to end up being 2208, as you see here on the chart, at payment one of year one. And that means you have you'd have $568 that could also be applied to debt reduction, which would reduce the amount you owe from 500,000 down to 499,431. Well, on the second payment of year one, the same thing happens. You make a payment of $2,776. A portion of that, and most of it actually, is going to go to pay interest. In this case, you're paying a little bit less interest, actually $3 less than the month before, and you're paying $3 more in debt reduction. And again, the amount that you owe on the loan gets reduced a little bit more. Now, when the bank goes to calculate how much you owe, the interest again gets reduced. The amount that you're paying to reduce the debt gets increased. The total amount that you owe gets decreased. And what you can see is if you look at this over a period of time, if you go to the 120th payment, at this point, the interesting thing to see here is that the balance between what you're paying in interest and what you're paying in debt reduction has really shifted quite a bit. So now the amount of interest you're paying is $1,817, but the amount of each payment that you're making is reducing your debt at this point by $960, and you'll have paid off almost $90,000 worth of debt on this particular loan that started at $500,000. Go to the 15-year mark and look at this. Now you're almost at a 50, it's not a true 50-50, but you're getting to where almost every payment you make is almost half interest, almost half debt reduction. And you've brought down that loan balance even further to $344,264. As you continue making payments, on your very last payment, you'll be paying $12 in interest, $2,766 in debt reduction to bring you all the way down to owing zero, and you will have paid off your loan in full. What's interesting here is look at the bottom of this. At the end of the loan, you'll have paid $1 million, $500,000 in interest, and $500,000 in debt reduction. And that brings us to the magic of why 5.3% is such an interesting number when it comes to borrowing money. It's actually, that's the break-even point, where if you were to buy a house for $500,000 and finance all of it, 100% financing, you would pay the seller on the day of settlement $500,000. And then over the next 30 years of making your loan payments, you'd also pay your lender $500,000 in interest. That's sort of the even mark. So as you go as rates go above 5.3%, you're paying more to the lender to own a house than you are actually paying to the seller from who you bought the house from. And this is why so many buyers are currently in the market, because at the time of this recording, the interest rates are closer to 3%, which makes it a very attractive time to buy because the cost of money is cheap. And as you can see, the cost of money is a big part of buying a house. So I started off telling you that this is a very competitive market. Homes are selling fast. What are some of the things you can do in a competitive offer to make your offer a winning offer? The first thing to remember is that speed is your friend. You want to get your offer in fast. Make sure the listing agent and the seller know you're interested in writing an offer and they don't accept another offer prior to yours being submitted. The next thing you can do is include in your offer something called an escalation clause. What an escalation clause says is, in the event that another offer comes in higher than mine, I am willing to beat that offer by an increment, let's say $5,000, up to a maximum. And let's say if the list price was $500,000, I would say I'm willing to go up to $550,000. That would be my maximum. So therefore, I'll beat any other offer that comes in over $500,000 by $5,000, but under no circumstances will I pay more than $550,000. The great thing about an escalation clause for you as a buyer is that it gives you two things. One, the seller has to show you proof of the next highest competing offer. So one, it's transparent, you get to see what's happened. And two, it gives you a sense that you're not grossly overpaying for the house. Yes, you're paying more than the list price, we understand that, but someone else was willing to pay about the same amount as you. And so therefore you get this sense of fairness that you're paying somewhat in step with what the market is willing to pay for the house at this moment in time. The other thing you can do to make an offer super competitive is to remove your home inspection contingency and buy the house without one. Now, that does not mean we don't want to do a home inspection. Ideally, what you want to do is, prior to submitting your offer, is have a home inspector come visit the property, walk through it with you, and give you the pros and cons of the house. The big thing is, hey, are there any big settlement issues or any, roof replacements or heating replacements or electrical defects? They're going to be big dollar items that you need to know about before you go into making the offer. And if they do that with you, then you may feel much more comfortable making your offer non-contingent on a home inspection, because you already had someone walk through the property with you that's a professional and give you all the pros and cons, so you feel comfortable understanding what the ins and outs of that particular property. Now, it's typical when you make offers to have contingencies, and if you are going to have a contingency, the shorter the time frame, the safer the seller's going to feel. So that makes the seller feel that much more comfortable. In some cases, though, however, you may feel, gosh, do I even want to remove my financing contingency? Without a financing contingency and without a home inspection contingency, if for some reason you can't perform, you just need to understand that your earnest money deposit is at risk. However, many buyers that feel very confident in their job security, very confident in their credit report and their credit history, they do feel comfortable making offers non-contingent on a financing contingency. That is something the lender will never recommend you do. I'm just letting you know that a number of people do it because many times that's what it takes to win in a competitive offer. The last two things you can do is pick a settlement date that the seller wants. Sometimes the seller wants to stay in the house maybe an extra week or two. Just give them a free rent back and let them do that. In addition to that, you can increase the amount of your earnest money deposit just to show them how serious you are in this entire process. Now, here's the thing. We've been talking about this really from the perspective of getting your house and all the activities that you're going to be doing with your real estate agent. But as you can see from this chart that you're looking at, everything on the left side that's in blue, these are what we call the realtor-related activities. But on the right side, these are going to be the lender-related activities. And you can see that they dovetail and mix and match, because the lender needs to get us the realtors things, the realtors need to get the lenders things, and you can see how these two items are interdependent. So we're going to let Kim take over from here, and she's going to talk about the lending process for you.
Great.
Go ahead,
Thank
Kim.
you. Thanks.
Yes.
Okay, let's go to the next slide. So as Ron mentioned, one of the first steps that you want to go through as you're preparing to purchase a home is to get pre-approved. That's really critical for understanding how much cash you need for closing, and also just understanding what you qualify for. Your credit report, the credit report that we run is good for 120 days. So keep that in mind as you prepare for your purchase. You want to keep your pre-approval, you want to kind of get pre-approved ideally within the 60 to 90 days prior to closing. But if you have any concerns about your credit, your income, or your assets, that would be a good opportunity for you to talk to a lender, and we can chat it out, figure out what your game plan might be. And if we need to make some corrections, if we need to talk to a credit repair specialist, we can also do that in advance so that you're prepared when you go in and you're ready to, you have your pre-approval ready to go. It's a great opportunity to talk to me, and we'll talk through and work out your particular situation. Also, if you have any concerns about how much cash you need for closing, that's a great opportunity for us to talk and I can lay out some options for you so you can see how much you might need if you put down 5, 10, 15 at an ideal purchase price. And then once you are under contract, your contract has been accepted by the seller, then you'll want to go in and you'll lock in your rate, because we do anticipate interest rates to increase over the next few months and into next year and beyond. So it's really important that you track the interest rate, talk to your lender about that, and get locked in as soon as possible. In week 1, you will sign your loan disclosures. And once you've signed your intent to proceed, then we'll order your appraisal and we'll get moving on that process. In that first week, you'll also send your earnest money deposit to the title company, and you'll start your homeowner's insurance process for applying and shopping for that insurance. In weeks 2 through 4, the appraisal should be coming back in, so we can clear that appraisal contingency, as Ron mentioned earlier. And we'll go through processing and underwriting. And then the final step in the process will be the clear to close. And we'll go to the next screen. So there are really 3 big things that we consider when we're qualifying you for a loan. We're going to look at your debt to income ratio based on your monthly debt obligations and your monthly income. We're going to use your gross income, and typically the maximum that you can afford or qualify for is all of your debts must not exceed 50% of your monthly gross income. The cash that you'll need for closing will be based on a number of different resources, but you can use gift funds, as Ron mentioned, stocks, CDs, 401k loans. That money doesn't count against your debt ratio, and checking and savings accounts. And then for the credit scores, we'll look at the 3 bureaus and we'll take your middle score in calculating what you qualify for. And then next. So what makes up your monthly payment is really based on a potential of 5 different things. It will be your principal and interest payment, and Ron touched on that when he was talking about the amortization schedule. Your property taxes and homeowner's insurance. You'll shop for your homeowner's insurance and you'll find a homeowner's insurance policy. We'll use that amount, but we'll estimate what that might be based on the purchase price of the home. Your property taxes will be based on whatever the jurisdiction that you live in or you're purchasing in says the property taxes will be for the property. And you'll pay a portion of that into your mortgage payment every month, a portion of your homeowner's insurance into your mortgage payment every month. And those amounts will go to pay the property taxes and the homeowner's insurance when those come due every year. Your mortgage insurance would be something that if you didn't put 20% down on the home, you would need to have this additional mortgage insurance for a period of time. And we could talk more about that in more detail so you can determine what might be the right fit for you. But mortgage insurance decreases, that factor decreases at 5, 10, and 15% down. At 20%, it goes away completely and you don't need mortgage insurance. And then some communities have homeowners association dues or condo fees. And condo fees can vary widely, and HOA dues can sometimes vary widely too. So really that needs to be a factor into your debt to income ratio when we're calculating what you qualify for. And next. So how interest rates impact your affordability is really a concern as the interest rates rise. Right now, interest rates are very low. And as you can see, at a $500,000 purchase with 5% down, you would be making $25,000 down payment. The closing costs typically account for about, actually, let's scratch that entire one. I'm on the wrong slide. Sorry. Yeah. So in this example of a $500,000 purchase with 5% down payment, to keep your monthly principal and interest payment at $2,002 per month, you would need to either increase your down payment by $7,000 for each 1/8 of a point increment in interest rate. So, for example, if you wanted to purchase at $500,000 with a 5% down payment and keep your $2,002 monthly payment, mortgage payment, the same, you would have to have an interest rate of 3%. If you did the same amount at the same purchase terms at 3 1/8%, your mortgage payment would rise to $2,034 per month. Next slide. It's important to prepare for the cash that you need for closing. So if we took the same example and we took a $500,000 purchase with 5% down, that's $25,000 down payment. If we estimate that your closing costs are typically between 3 and 5%, in this example, we'll use $15,000 as the closing cost. That would make your cash to close amount $40,000. Now, a portion of that would be paid in advance with your earnest money deposit, but the remaining balance is what you would need to come to closing with. Next screen.
So,
all right, this is back to you, Ron.
Yeah, sure. So people are always asking us the same question: is this a good time to buy? And timing a market is difficult. I mean, no one can. People just can't time markets. You may think you can, but it's a very challenging thing to do. As a home buyer, you're actually trying to time two markets simultaneously. First is the cost of money. That's the interest rate fluctuations. And then the second is the cost of a house. And we know that right now, those two things are at extreme. The cost of money is less than it's ever been, and the cost of housing is more than it's ever been, making it a challenging time to figure out if this is a good time for you to buy or not. But I think what it ultimately boils down to is how long are you going to live in the house? The longer your horizon, the more things tend to work out in your favor. And the shorter the horizon, you're relying on a certain amount of good fortune for things to work out. And it goes back to how wealth is created in real estate, those two slides. If you remember, over a long period of time, the value of houses tends to go up. And over a long period of time, the amount that you owe tends to go down. The difference between those two amounts, that's your equity, that's your gain in net worth. So if you're planning to live in a house for 7, 10, 12 years or more, that's typically a really good opportunity for you. If you're thinking this is a 2 or 3 year purchase, that could be a little bit more challenging. And unless you catch the market just right, you may find that when it's time to sell, you may not be that happy. So for those of you that are thinking about buying, we understand that a lot of you are renting right now, and you have to sort of figure out, okay, when do I need to start my search relative to when my lease ends? Because you don't want to sign another lease typically if you're going to buy, right? So this is an important rule. It's called the rule of 66, or the 66% rule. And what it states is that once 66% of your opportunities have passed, the odds of being successful begin decreasing. And so think of it this way. If you have 100 days between now and the time that you have to sign a lease, on the 66th day, if you still haven't found a house that you want, you only have about 34 days left to find a house. So the odds that you're going to find a house in that remaining 34 days, as each successive day passes, the odds of actually getting the outcome you want begin to drop. So therefore, we just want to, as we say this, we want to make sure that one is you calculate up front when you're working with your realtor, how many opportunities of homes to purchase do I think I'm going to have per month? In addition, how much time do I need? How much lead time do I need to actually find an opportunity that, when I find a house I like, and two, because it's a competitive market, I'm able to actually win in the competitive process. Because remember, if a house gets 3 offers, that means one person got it, but 2 people did not. And those 2 people, when the next one comes along, I've seen this over and over again, people who've lost on previous bidding wars become super aggressive on the next one. And it's the person that's lost 2 or 3 times in a row that's typically going to win on the 4th try, because they've just had enough already and they're willing to go all in. So to the extent that you want to, embark on this journey of buying a home, and we hope you do, one of the things that's important is having an advocate in your corner, someone that's representing your interests the entire way through. And that's what buyer agency does. A buyer agent's role or job is to look out for your best interests throughout this entire journey. And that by law, it actually spells out some very specific things. It means confidentiality, obedience, loyalty, due diligence, accounting and disclosure. And these are all things that you can rely on your agent to do on your behalf to make sure that you're not making any rookie mistakes. And ultimately, you want someone that's going to really provide, their experience, their judgment, and their expertise so that you have it in your corner as you're going, down this process. So what does a buyer agent cost? So typically to have a buyer agent represent you, you need to sign a buyer agency agreement. And the way the buyer agency agreements work here locally is they say that in the event that the seller is paying a commission to the buyer agent, then typically the buyer doesn't need to pay anything. And I will say that is true of 99.99% of the times. In my 24 years of business, not once has the buyer had to actually pay us a commission because it's always just been out there that the seller's been willing to pay it. So to the extent that you are thinking of hiring a buyer agency, you just want to make sure you get somebody who's competent, who's going to do a great job for you. But the cost of that buyer agency is not something statistically, it's not something you will have to bear. You're on mute.
So first things first, let's get pre-approved. So there are a lot of great reasons for getting pre-approved. There are no surprises. You'll be ready when you find your dream home, just so that you don't fall in love with something that you don't qualify for. You need a pre-approval to make an offer, and sellers don't accept offers without pre-approval, so you must get one. Knowing your numbers is also important. So it gives you peace of mind. You know how much you can afford, you can plan for your monthly payment, and you can plan for how much cash you need for closing. And that's really critical for making sure that you can get from your offer to closing. All right, Ron?
There you go. All right. So we hope you enjoyed this. So next steps. One is, Kim just said it. You want to start that pre-approval process. That's, knowing where you stand financially is going to give you, without that, you really can't do anything else. So Kim's got a great process for starting that process with you. You can see her information there on the below. And then one of the things that we like to offer to our clients is a buyer orientation meeting. What we did today was really high level stuff. We want to take it the next level down and do an orientation that's very tailored and very specific to your search criteria. During that orientation, we actually go live into the Realtor MLS and set up a search for you as well, and calculate how many opportunities per month we think you're going to have as you go down this home buying journey. So both Kim and I, we hope you enjoyed this presentation. We'd love to hear from you. If you have any questions, please feel free to send us an email, give us a phone call. We're always happy to help. Thank you so much.